companies to take. Good morning and welcome to this seminar titled Paying Taxes in India. My name is Steve Toogood and I'm Director of Regions for UK-India Business Council and will be moderating this webinar. It's a complicated landscape, especially with regards to tax in India, but changing rapidly, and we always recommend companies to take good tax advice at an early stage of their engagement in the country. And I'm sure that this seminar will give you a good basis and foundation of understanding, which is essential for your journey there. Before we begin, I would like to familiarise you with the toolbox on the right-hand side of your screens. Just to let you know, we will have everyone on mute during the course of the webinar to keep any background noise to a minimum. But if you have a question, please drop it into the little bracket on the toolbox to your right in the Please Type Your Question Here section. That will send me your question, and I will be sure to take up as many as possible during our Q&A session after the PwC presentation. For now, to make sure you can all hear me clearly, could I please ask you that you use the Raise Your Hand button on the toolbar. So could you all please click the Raise Your Hand button for me? Okay, thank you very much. So, to our speakers today. I'm very pleased to welcome Raj Julikia. He's a tax advisor and partner and leads PwC's International Structuring Group in the Southeast. He's a qualified chartered accountant and chartered tax advisor and has been with PwC in the UK since 1997. He advises clients on how to structure and finance their investments into and out of the UK, including company acquisition and disposal, and has a keen interest in the tax systems of the Far Eastern territories, with extensive experience in structuring investments into India, China and Singapore. He's joined today by Keshav Mundra, who sits on PwC's India desk in India and is on secondment here to the UK, looking after inbound and outbound taxation issues. So, with all that done, I pass you over now to Raj for his presentation on international taxation in India. Thank you, Raj.
Thank you very much, Steve. Good morning, everyone, and welcome to this presentation. And thank you for the introduction, Steve. So I am an international tax partner with PwC in the UK, and part of my job involves spending quite a bit of time advising, particularly UK clients, setting up business in India in conjunction with our firm in India. As Steve said, the topic of the presentation is paying the right taxes in India, and in our experience, one of the issues that clients grapple with when they are setting up business in India is to get an understanding and an appreciation of the vast amount of taxes one could be subject to once you set up business and get going. So if we could have the agenda slide, please. I'll take you through what we're going to cover for the next 15-20 minutes or so. The presentation very broadly is divided into two parts. We'll spend some time looking at the corporate taxes in India, and I'll cover that part. And my colleague Keshav here is going to talk a little bit about indirect taxes, and then we'll finish off with some questions and answers. If I could have the next slide, please. So before we get into the detail of all the various taxes, I think it'd be quite useful to just take a step back and look at if you want, the themes of the Indian tax environment. And traditionally, India has been regarded as a very high tax regime, so high effective tax rate, and we'll go through some numbers in a minute. I should qualify that a little bit because there is a new government in India, and there have been, if you want, the right noises about reforming the tax system to some extent to make it more attractive for business. So as you will see in a minute, there is some proposals that they put on the table in the recent budget to try and reduce the corporate tax rate. And another key feature of the Indian tax systems is that it is quite bureaucratic. There is a lot of paperwork to complete. So there is a fairly onerous tax compliance obligation to comply with when you're doing business in India. Again, there are some signs that might be easing a little bit, particularly for example, in terms of bringing things together, automating things to make them more accessible online, to make things quicker. The other aspects you tend to hear quite often when you deal with India is that it is an environment where there's a lot of dispute on tax matters, long-standing disputes which go on for a number of years, litigation, etc., especially at the lower level, at the level of dealing with the tax inspector. Again, we'll touch on that later. The government, I think, is keen to change that perception of India, and there are certain things they have announced that seems encouraging. And then finally, there is a key, if you want, focus on collection of taxes and withholding tax. So generally, when payments are coming out of India, other than just kind of general payments for goods and services, there is a question of whether there should be withholding tax. So typically there will be withholding tax on things like interest, dividends, royalties, fees for technical services. And there is a complicated indirect tax regime. At the moment, there is a federal regime and a state regime. Keshav will talk a bit about that later as to how they're planning to unify the system. So if we will move on to the next slide, I don't really want to cover that in a huge amount of detail. It's kind of there for you to have a look at some of the headlines, if you want, that is coming out in the press about how India is seeing itself with this new government in terms of its economy and reforming its tax system. I think it's sufficient to say at this stage is that the government, it seems to us that they are serious about reforming the tax system to some extent. So if we move on, that's one to the next slide. That's one slide I'd like to spend some time on because really it kind of sets the scene about as to where this current government is willing to go. So I'm going to pick on a number of items that were announced in the recent budget and make some comments around them. So the key one is a proposal to reduce the corporate tax rate to 25% over 4 years. And in addition to that, to bring in some phase elimination of tax exemption. So what that is effectively doing is broadening the tax base, but reducing it. They've proposed also some clarification on the indirect transfer regime. For those of you who are familiar, it's been well publicized. There's been a lot of litigation and debate around the Vodafone case issue as to whether India should seek to tax the transfers of subsidiaries where those subsidiaries indirectly hold Indian investments. Other things that seems quite attractive or welcome, there's the general anti-avoidance rules that they were proposing, which when it first came in was actually very onerous, put a lot of burden on the taxpayers. That's been reformed over time, and in addition to that, they have been deferring it. It's now deferred until April 17. Another welcome measure in terms of reducing taxes in India is there is a proposal to reduce withholding tax on royalties and fees for technical services received paid by Indian residents to non-resident from 25% to 10%. The direct taxes code, the reform of the legislation, which has been in place for a number of years now, that's not going to be adopted. So they are really, it seems to us, focusing on kind of reforming the existing legislation. The other useful announcement is that there's going to be more frequent circulars issued by the tax authorities, by the Central Board of Direct Taxes, clarifying disputed tax position. And that's quite useful because often a major issue in India is around interpretation. You get different interpretation of the same legislation. So clarifying what the legislation means will or should reduce the number of disputes. There's been an assurance from the government that there would be no retrospective tax amendments. They've made that statement more than one time, and that's helpful. We're starting to see more advanced pricing agreements. So this is on respect of transfer pricing between connected parties, between India and other countries. There's one which has been negotiated recently with the UK, and the beauty of that is effectively the way it works will give you 9 years, up to 9 years certainty, because you can apply it for the last 4 years and a prospective 5. And overall, a general kind of non-adversarial approach towards taxpayers. If we move on to the next slide, if we could jump the slide and go straight to the slide that's headed Overview of Key Corporate Taxes. If we jump the tax framework in India, and to that slide, thank you, please. So that just gives you a quick overview of rates of India, of Indian corporate tax. As you can see, I'm not going to go through all of them, but just at a very, very high level, the corporation tax rate is around just short of 35%. If you compare that to the corporation tax rate in the UK, for example, which is 20%, the rate in Ireland, which is 12.5%, and some of the rates around the various kind of European countries, this seems quite high. When you add to that the rate that you pay in terms of extracting profits out of India, the dividend distribution tax of 20%, that's starting to get quite high. So, and this is for a domestic company. A foreign company doing business via a branch or permanent establishment, you can see the rates down the bottom of the page there. The corporation tax rate is even higher. If we could move on to the next slide, that probably sets it up more, in a much kind of simpler way. If one looks at the top line, how much profit one is making, 100, and trying to kind of work out what the corporation tax is in India and what the dividend distribution tax is after you've extracted the profit. So if you are making 100 as a company currently, after paying all your taxes, that would leave you with about 55. So that is still quite a fair amount of tax. By 2019-20, when the tax reform has come through, we expect that to be around 60. By way of comparison, in terms of how you set up for doing business in India, we've put on the right-hand side what the comparison would be for a limited liability partnership. And as you can see, that reduces the taxation impact, mainly because there's no dividend distribution tax. If we can quickly move on to the next slide, please. I mentioned earlier there is a number of compliance requirements, so it's fairly bureaucratic. So when you do business in India, there's a number of tax registration to do. You have to do things like permanent account number, tax deduction account number, etc., etc. So there's just a huge number of paperwork. There isn't currently what I would call a one-stop shop. So you can't do everything in one go. So if you compare that to the UK, generally you set up a UK company, you register with Companies House, and then you do your tax registration for corporate tax and VAT, AY, and those are fairly straightforward, and you're done. There is often a lot more to complete and deal with in India. If we move on a few slides, please, in the interest of times, and we move on to the slide headed offshore and indirect transfer. So I'm jumping some slides because they deal with the same thing to do with compliance. Thank you. I wanted to just really quickly touch on that. One of the points I made earlier regarding the Vodafone case, so there has been a lot of uncertainty as to, particularly for large groups when they're doing intra-group reorganizations, or indeed shareholders on listed markets who hold a fair amount of investment selling their shares, as to whether there is an Indian tax liability on them if ultimately the group they are investing in or the group they have some form of Indian asset or Indian investment within the group. So there was always a lack of clarity as to what India would seek to tax. The government has come out and clarified that, and they've clarified it very well. So the first thing they've said is that you only get into this sort of issue if the Indian asset constitutes at least 50% of the overall value of the assets that you're dealing with. So if you take a large UK group, for example, and you hold shares in them, and they happen to hold an Indian investments, and you're selling those shares, the Vodafone issue only becomes an issue if those Indian assets are more than or at least 50% of the overall value of the group. So that's a long way to go. So that's clarified. And the other threshold they've put is that the value of the Indian asset must be greater than 100 million Indian rupees. So again, that sets a nice de minimis. They've also said things like shareholders who have less than 5% of voting power or right of management in an overseas entity, and they sell the shares in that overseas entity. If that overseas entity happens to earn something in India, they would not get caught by the indirect transfer regime. So in the interest of time, that's all I wanted to cover, just to give you a flavour of the corporation tax regime. In summary, it is a high tax regime. There is a lot of paperwork if you want, but the good news is the current government is keen to try and change that, and they're starting to go down the right track. So let me pass over to Keshav to cover indirect taxes.
Thanks, Raj, and welcome everybody. So I'll cover the indirect taxes regime in India. If we can move to the slide titled Current Indirect Tax Structure. Yeah, thanks for that. So as you can see, in India, the indirect tax structure is pretty complex. This is majorly because there's a federal structure and there's a state structure. The federal structure governs the taxes at the manufacturing stage and the service taxes, whereas the state level of indirect taxes govern taxes at the sales level. And that results in a lot of paperwork, a lot of compliances that one has to do in terms of services, in terms of goods. And as you may know, that the tax rates are there on the slide. It's fairly around 14. It ranges from 14% upwards. And as you may know, the GST model is expected to come in India. And I'll talk about it in detail later. But what it's supposed to do is take out all the taxes, most of the taxes, and bring a single tax regime, wherein you will have one tax at the federal level and not much at the state level. That would essentially reduce your paperwork and reduce the complexity by bringing in a single tax return and allowing all type of taxes to be creditable against each other. Rather, it would be just one tax, so you would have input for one and credit output for another. If we can go to the next slide. Yeah, so this slide basically gives what changes did the India budget do. And the budget was a step towards this GST. And the process starts with this budget because India has committed to bring GST in April 16. So some of the examples of how they have done that is one of the is increasing the service tax rate to 14%. They have moved away. They have done it away with all the cess and surcharge that used to be there in the indirect tax regime. So it's a flat rate now, be it for service tax or be it for excise duty, which has gone up marginally from 12.36 to 12.5. And there is a talk of an additional 2% of cess, which would effectively increase service tax to 16. But that is expected only for high-end and only notified services. There is a lot of rationalization in the tax law, which is essentially towards penalties and the way taxes are applied, and that is very welcoming because it clears out a lot of ambiguity around how the rules are applied. If we move to the next slide, please. So this gives an idea of where the government is moving towards, what are the intentions. The concept here is Make in India, wherein the government wants to encourage in foreign investment and local manufacturing. So in manufacturing, I should say, and that's why they have come up with special rates, reduced rates where manufacture is done in India, and at the same time they have increased some rates for, say, mobile handsets, cell phones, where on customs, so that import of that becomes costly and local manufacturing is much cheaper. So that's what the encouragement is towards. And if we go on to the next slide, which is about GST. So this is how, when we get to the final GST model, there will be one level of unified GST all around the country, except for a few taxes, which would be like customs, which is on import, and the mechanism there would lead to all input creditable against the output that you have. And some of the benefits that is expected out of the GST model for everyone, for the businesses, would be an improved cash flow, a simple tax regime, tax structure, easy administration, and less cascading effect, because at present the cascading effect results in your taxes to be much higher than what it shows. And if we go on to the next slide, we'll see how the GST, where is GST today, and what are the steps that are required to put GST into place. So essentially there are two stages for GST to be implemented. The first one being the Constitutional Amendment Bill, and this is required because at present the federal government doesn't have the power to implement taxes on goods. So this Constitutional Amendment Bill will give them that power. The bill is recently in Parliament and being discussed. The next stage would be, after the Constitution is amended to give the powers, would be actual GST bill, which would be the actual legislation. The legislation is going to be drafted and finalized once the power is given, and there would be a broad-based committee. So a lot is to be done, but we see that the government's intention is towards it, and they are moving and giving out positive messages that GST should be in place by April 16. That is essentially what we wanted to cover on indirect taxes. And I think I'll pass on to Steve now for any questions that we have.
Steve, I'm afraid we can't hear you, so I'm not sure whether you're just going through the questions or there's it.
No, sorry. Thank you very much, Raj and Keshar. Apologies for that. Hopefully you can hear me now. Right, well, thank you very much for that presentation. It's most helpful. And just to confirm, we will be sharing a copy of the slides with all listeners after the presentation. If anybody would like to ask a question, please can you enter that into the question box on your side panel, and I will endeavour to complete them for you and ask the questions. So first, we've got a number coming through. Firstly, I've got one on reclaiming withholding tax in India. Can you advise how easy it is to reclaim Indian withholding tax for UK registered companies?
Yes, so there is the possibility of reclaiming withholding tax. Clearly, you need to do all the paperwork. The process is rather drawn out. It does take time. So I'm going to ask Keshar to just give a quick overview of how that happens in India.
Yeah, thanks, Raj. So the process is like, if you have suffered withholding tax in India, the company that has deducted tax on you, they will ask for initially a PAN number of yours, which is essentially an income tax registration in India. If you have that PAN number, it's much more easy, the process, because you have the credit against an identified number, which is your unique number. If you don't have the PAN, unfortunately, you will suffer a withholding tax at 20% at least, and that would increase your taxes, and that might have an impact on the amount you can claim as a credit. And the process is the Indian company deducting tax will give you a certificate of withholding that is called a tax deduction certificate, and based on that tax deduction certificate, you might have to file a tax return in India. That would be a limited return, wherein only your income from India, unless you have a permanent establishment in India, only your income from India would be recorded, and the tax you have suffered in India would be recorded. And if you have to pay any additional taxes, that would be recorded. From a claim perspective, you can use the treaty, wherein you get a foreign tax credit in the UK, and these are the documents: the tax deduction certificate and the tax return in India, if you filed any. That would be helpful in determining what is your taxable income in the UK and the tax credit you should get in the UK against that.
Yeah, I should probably just add that for corporate taxes, there is a provision in the UK law that if you don't take reasonable steps to minimize your foreign taxes, then strictly you cannot get a credit for foreign taxes.
Okay, thank you very much. I mean, there was a question came through on double taxation law, and I think you have covered that to an extent. If a company does not have a PAN registration, then does that then mean that they will not be able to claim back under the double taxation law?
So from a UK perspective, that technically means you haven't taken reasonable steps to minimize your foreign taxes. So you wouldn't be able to get the credit for, in practice, so that's kind of means you pay 25%.
You pay 20%.
20%, and the minimum rate you would have got to, if there was the relevant paperwork, would be 10. So you would potentially miss out on 10% of the credit, because that 10% would have been avoided had you had the PAN.
Yes.
Okay, and it's a key point for anybody providing services into India, consultancy or service upgrades, anything like that. They should look at getting a PAN straight away. Question come through. How can you just very quickly? How easy is it to get a PAN? Estimate of cost and the process.
So the process is both online and paperwork. You can file an online form, print that out, and if you're a company in the UK, there would be certain supporting documents. Those are basically an identity proof and an address proof. If you're a corporate, then your certificate of incorporation, which generally has an address as well, would serve the purpose. You would need to get that apostilled in the UK, and then send the form along with that supporting document to a specific address in India, which will then process the form and give you the PAN number. You can there's a facility to track the application online as well. From a cost perspective, it's the application cost itself is £10 for a foreign company, and the postage, and also you can get it for £25 to £50 max. And from a timing perspective, once you submit the application, generally it takes 15 to 20 working days for them to issue, until and unless they would require additional documentation.
Okay, thank you very much. I mean, I think the thing is, it doesn't cost a lot of money to do it. Get yourself an Indian accountant to support it, just to get the things stamped in the right way, and get it done as early as possible, because it's going to help you with withholding tax. Thank you for that. There's questions with regards to permanent establishment in India. If you're operating out there, you can actually end up liable to tax on profits out there. Is that correct?
Yes. So, I mean, India has traditionally taken a fairly strict view on what creates a permanent establishment, and the way they approach it by looking at domestic legislation and treaties is not necessarily the way that you might see other countries, particularly in the Western world, approach the concept of permanent establishment. Having said that, that is changing with this whole debate around base erosion and profit shifting, the BEPS debate, and there is a number of reform being proposed by the OECD in terms of permanent establishment. So, in a way, maybe the OECD might move a little bit closer to where India is. To go back to the Indian aspect of it, there are a number of things that can trigger, from a technical perspective, trigger permanent establishment. For example, a fixed place of business, and in particular with India, they do approach this concept of service pay in quite a strict way. So they do look at treaties, and they do look at whether people flying over from foreign organizations into India are spending a certain number of days in a particular year. And to give you an example, in certain cases, you could trigger a P if you spend 90 days on the ground. What does that mean? You have the foreign company then will have to effectively register a taxable presence in India, and a tax at the very high rate that I described earlier, somewhere around 46%. So actually managing and keeping on top of who is visiting from a particular company, who's visiting India, how many days they're spending in India, etc., is important. It doesn't mean the mere fact of visiting India creates a PE, but at least you know what's happening. You do need to look at the activities that they're carrying out.
Very good. Thank you. I'm just going to nip back to PAN, I'm afraid, because there's quite a stream of questions coming in on that. So just with regard, if you have a PAN number, does that mean that the withholding tax by the company in India will then immediately drop to around the 10% level?
Yes, essentially yes, because the domestic rate in India, and I'm talking only in respect of fee for technical services and royalties, the interest rate can go from 5% to 20%. If we go on fee for technical services and royalties, if you have a PAN, it can go on the domestic rate, which is 10.82, and the treaty rates generally hover around 10%. So you might consider, if you want the treaty rate, which is another saving of 0.5%, you would need to give a tax residency certificate, which most foreign tax authorities, they issue pretty easily. So.
Yeah, that didn't quite, just to add to that, didn't quite used to be the case, because the way the rates were working, yes, having a PAN didn't make a huge amount of difference, but since the recent budget, that made a big difference.
Yeah, for the last 2 years, that didn't make a difference because the domestic rate was 25%. So essentially, even having a PAN would not reduce the rate a lot unless you take the treaty benefit. And just to add one more point on the PAN, having a PAN doesn't automatically mean that you have to file a tax return in India. You have to do a lot of compliances in India.
Okay, very good. Thank you for those. Right, we have another one here, repatriation of capital and profits. Can you give us some idea of what the typical preferred way to do this tax efficiently is? Okay, so
there are a number of ways of thinking about repatriation. So one aspect is to just think about how you structure and finance the investment. So to the extent you are able, and there's a number of regulatory issues to deal with, and I'm going to kind of not cover those on this call, but assuming you've dealt with the regulatory aspects, you should be able to finance, in some cases, your investment in India by way of debt. That can be tax efficient because it allows you to bring profits, cash out of India by way of interest, whereby you get a deduction in India, and that interest would be taxed at a much lower rate than what the Indian corporate tax rate is. There is withholding tax on interest. They vary generally from 5 to 20%, depending on the type of loans you're making, for what purposes, etc., and whether there is a treaty benefit or not. But if you think about it, you're saving 34 for the sake of maybe 20% withholding, or you get 10, or in some cases 5. So that's one way to think about it. The other way is obviously just making sure the Indian business has adopted a proper transfer pricing policy where you actually charge it everything you need to charge it, including things like royalties, technical service fees, potentially management fees, etc. Obviously, once you've gone through all that, you're really then talking about the profits that's left behind. And unfortunately, you then have to extract that by way of dividend, and there's no way to avoid, to really mitigate the dividend distribution tax. There used to be techniques that were available to kind of change the nature of the repatriation, but last year the government changed the legislation, and that's no longer possible. So very in summary, 3 or 4 ways: interest, royalties, technical service fees. Think about your transfer pricing seriously, and dividends or capital.
Very good. Well, thank you very much, Raja and Kishore. It's been excellent to hear from you and your well-placed advice. As I said, we will share the slides with everybody. So thank you very much for your time, and I hope this webinar was valuable to you. If you have any feedback or comments about today's session, or a session that you want to see us do in the future, please do feel free to get in touch. Thank you again for joining us. Goodbye.